Hi folks, welcome to this video on bonds. Now we've presented something a little bit different here. What we've looked at now is we've got a situation whereby we've given you the table for the bond instead of having you prepare it, and we want you to read from it and be able to interpret some aspects of it. So here we can see that the bonds, we're not telling you what the face value is, but you can see the coupon is 9%, where the market rate is 10%. So you should be thinking that because our bond is not paying as much as the market's paying for items of similar risk, that we have a discount bond. So in here we'd be wanting you to type in the word discount, okay, into the table. All right, so now now that you know that it's a discount bond and you know where you have to put that in our table, we've asked you here to think about the fact that apart from interest being paid semi-annually, what's the par or face value of the bond? So again, we don't have to have you calculate the present value because we've already given it to you, but we know that the present value or carrying value of the bond at the issue date plus the unamortized premium is going to give you the bond at its face value. So again, if you were doing a balance sheet, it would be $100,000 for the bond payable less the unamortized discount to give you the carrying value. So let's just see. We didn't ask this question, but if you were to do on the balance sheet, we're not asking you to do one, but in the long-term liability section, just put liabilities, what would we have? We'd have a bond payable, and again we know it's a 9% bond and it's due in 5 years, which is December 31st, 2014, and it would show in our balance sheet at its face value, right? And then from that we would deduct the discount, and the discount would be looking at the unamortized piece, which here is $38.51 at the issue date, and that would give us the bond. Oop, I'm typing here and you can't even see it, can you? At the carrying value, and that would be, again, we can get it right from our table right there, $96,149. Right? So again, in a discount bond, you would take the face value less the unamortized discount to get the bonded carrying value. If, on the other hand, you happen to have a premium bond, you would add in the unamortized premium to get a carrying value. And the carrying value will always be less than the face value if it's a discount bond. If it's a premium bond, then you're going to have the carrying value, which is greater than the face value, right? So now that we've got that done, again, they wanted us to do the journal entry at the issue date. And again, we can pick it off right here because that's our issue date, January the 1st, 2010. This is our issue date. And we have our unamortized discount and our carrying value. So we can set up your unamortized discount, which is $38.51. Set up your cash, which is the present value of the bond at the issue date, and credit the bond payable itself. If we had to record interest, the interest payment at June the 30th, 2012, again, we can go right to that area of the table right here and see what? And see that that was our interest we'd expense, that was our payment, and the difference between the two is going to be the discount that we amortized. So in this case, we would set up the interest expense, which we said here is $48.74. Credit the bond discount for $3.74, and then credit cash, which is the interest payment. Again, at December 31st, 2012, same thing. Let's go to that area of the table, and we're going to debit interest expense for $48.92, and we're going to credit the amortized discount for $3.92, again showing us that we paid out cash of $4,500. Now, one thing that this question asked you to do as well is to show how much interest expense would be shown on the company's income statement for the entire year that ends December 31st, 2012. This is a little bit different. You haven't been asked that directly before, but you should know how to do it. This is just a different thing we can do to see if you know how to read the table. So we know that within any given year, and specifically 2012, we have two 6-month periods within which we booked interest expense. So doesn't it make sense that if we add the interest expense that we booked for the 6-month period within the year 2012 that ended June 30th, and the 6-month period that went from July 1st to December 31st, wouldn't it make sense that those two amounts added together would be our interest expense for the entire year? Sure. So let's go back to 2012 and find the two interest payment dates within which we booked interest expense. So let's go there. In 2012, we can see we booked our first interest expense at $48.74, and then for the next 6-month period within the same year, 2012, we booked $48.92. So adding $48.74 and $48.92 is going to give us the interest expense for the entire year 2012, which would show up on our income statement, and that would be $97.66. To do a partial balance sheet at the end of December 2012, we would look in the non-current or long-term liability section, bond payable, 9%. Sometimes you'll see the coupon and then the mention of bond payable, but you can do these in reverse as well. But the fact is it's due December 31st, 2014, and that's going to be the face value. Because it's a discount bond, we deduct the unamortized discount, which is $17.60. And if we looked at the 6-month period that ended that date, we can get this $17.60 right from our table. So if we go to December 31st, you can see it's sitting right here, the unamortized discount of $17.60, and that's going to give us a carrying value or present value of $98,240. And that should be what we see right here at December 31st, 2012, and that's going to be the carrying value of the bond on our balance sheet at that date, December 31st, 2012. Now, the next thing we ask you to do here is assume that we retired the bond early. So we didn't go to the end of 2014, which would have been the end of the 5-year period, which is when the bond matures. The company decided for whatever reason that they wanted to buy the bond back from the investors, right? And they were going to pay them $95,000 at December 31st to buy it back. So they were going to pay them $95,000. They already made the interest payment at that date. So after they made the interest payment, they approached the investors and said, we want to buy the bonds back from you for $95,000. Let's assume that the investors agreed to that. What would the journal entry be on the issuer's books? The issuer is ABC Company. Well, ABC would no longer have a bond payable on its books of $100,000. You'll remember here that when we did the journal entry at the issue date, right, we booked the bonds payable, we set them up at $100,000. Well, that bond's now gone, right? Because they decided at this date, if you look at this date, this is the date at which they're retiring. The bonds are sitting there at $99,085, right? But the face value of the bonds that we're getting rid of is $100,000. So now what we're going to do is we're going to get rid of the $100,000, and we're also going to get rid of any unamortized discount on the bond. And if we went to this period, December 31st, 2013, in our table, and we looked for the unamortized discount, we would find it. And it's sitting right here. $9.15. Well, because we're not going to be amortizing any of this $9.15 for the next two periods, these two periods here, we're not going to be having the bond in our assumptions. We got to get rid of it. So the bond is normally a debit balance, so to reduce it or to get rid of it, we're going to credit it. We already know that we're going to pay out cash of $95,000. So if we look at the debit of $100,000 and compare it to this net credit so far of $95,915, we can see that we're a little light on the credit side by $4,085. So this must be the amount of the gain on retirement. Well, for sure. And we can calculate that logically as well, not just by calculating the amount here to credit just to balance the entry, but we can say, hey, if we're paying investors $95,000 to retire a bond on our books valued at $99,085. And where did I get that amount? Well, we're carrying that amount of the liability right here. It said it right here at December 31st, right? So if it's only costing me $95,000 to extinguish a liability that I've got booked at $99,085, then ABC company has a gain on retirement because it costs them less to retire the bond than they have the liability booked on their records, right? So it's costing them less to retire it, right? Then it's booked on their records, so that means that they have a gain. So logically, you can figure that out as well. So this concludes our video on bond discount.